New Zealand's financial system is sound but continues to face risks. Global growth has been subdued despite extremely accommodative monetary policy in many countries, and financial markets have remained volatile due to heightened political uncertainty. Dairy prices have recovered in recent months, and the average dairy farm is expected to be profitable this season. However, debt levels have increased over the past 2 years, and problem loans are likely to continue to increase for a time. House price inflation in Auckland has softened in recent months, but it's uncertain whether this will be sustained. Auckland house price to income ratios remain among the highest in the world, and prices continue to rise rapidly in the rest of the country. There is a significant risk of further upward pressure on house prices so long as the imbalance between housing demand and supply remains. The Reserve Bank has asked the Minister of Finance to agree to add a debt-to-income tool to the Memorandum of Understanding on macroprudential policy. While the bank is not proposing to use such a tool at this time, financial stability risks can build up quickly, and restrictions on high DTI lending could be warranted if housing market imbalances were to deteriorate further.
Of course, the new investor LVR restrictions came into force on 1 October. These restrictions, along with the earlier LVR measures, are increasing the resilience of bank balance sheets to a downturn in the housing market. However, the share of bank mortgage lending to customers with high DTI ratios has been increasing, and this could worsen the rate of loan defaults during a downturn, housing downturn. The banking system has strong capital and funding buffers, and profitability remains high. Despite being relatively concentrated, New Zealand's banking system appears to be operating efficiently from an international perspective based on metrics such as the cost-to-income ratio and the spread between lending and deposit rates. However, the banking system's reliance on offshore wholesale funding is beginning to increase due to a widening gap between credit and deposit growth. Banks could become more susceptible to increased funding costs and reduced access to markets in the event of heightened market volatility. Damage from the 7.8 Kaikoura earthquake on 14 November is being assessed. While it's too early to estimate the cost to insurers, the sector is well positioned in terms of catastrophe reinsurance cover and capital buffers. And finally, the Reserve Bank continues to make progress on a number of regulatory initiatives, including a review of bank capital requirements, amendments to the outsourcing policy for banks, and a dashboard approach to quarterly disclosure.
The earthquakes, why doesn't it pose, or why have you said it's not likely to present a risk to the financial stability?
The insurance industry is pretty well set, pretty well prepared for shocks of this sort. Since Canterbury, they have built up re-established reinsurance cover, capital buffers, so that the industry overall is we think, well covered for catastrophe risk. Part of that's related to prudential standards that we are setting in terms of the extent of that cover required. So, in terms of the sort of magnitude, clearly it's going to be substantially less at this point, notwithstanding the risk of aftershocks. The numbers are substantially less than for the Canterbury situation.